This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
And welcome back to the Vancouver Commercial Real Estate Podcast. I'm Cory Wright.
And I'm Adam Scalena.
And I'm your sometimes host, Matt Scalena, but not this week. Why am I here?
Yeah, I don't know. You were in the studio and then we pushed record before.
Well, I think what it was, you probably heard the last couple episodes where you guys weren't here. And now it's kind of like, you know.
we got to double up on this one.
We got to try to get these listeners back so they bring in the heavy hitters, not just sit here and smile.
If we brought in the heavy hitters, we'd be bringing Melisa. And I think that's the only one that anyone cares about. But yeah, this is an exciting episode because we had the big news right now, Cory.
Yeah.
We had a rate cut.
25 basis points to the policy rate to 4.75.
So it's about a Starbucks a month or what?
I might be pushing it more like at Timmy's.
So here's the question. And maybe I'll put it to both of you. Adam, residential wise,
I feel like the phones are ringing a bit more, a little bit of activity increase. My thoughts on it though is like, if you think about it, the reverse. So when interest rates started climbing, activity did not shut off after the first interest rate increase. It took like 3 really before things started to kind of really slow down and moderate. Will the flip side of that happen? Like, will we have to see 3 rate cuts basically before the market really starts to take off?
Well, I think the biggest thing, and this is what we'll talk about on the program today with Jon from Impact breaking this down for us, is really what does 25 basis points really equate to?
Yeah.
And you know, sometimes I think it just sends more of a message that the tightening measures that the federal government did, they feel have done what they had to do, that now we're kind of coming off of that, more so than kind of like, oh my God, this is going to be a good deal. Now look at the interest rates come off.
Right.
Because you look at prime, if 4.75 is a policy rate, you add 2.2 to that. Prime's now 6.95 at most banks, down from 7.2. It's not like it's sitting at 4%.
Yeah.
So I think to your point, I think it's going to take a couple more rate cuts to kind of really get momentum going. On the flip side, if they cut rates too fast, that could also be because we're having economical challenges.
Yeah.
That then no one can buy anyways.
Well,
so
the other thing I was thinking about too is like the timing. If this rate cut happened in February, March, would activity increase more so than if it happens in June? I'm thinking like right now, it's like we catch a couple nice days a week. Yeah. It's like people are almost focused on summer. It's an interesting time to get a rate cut.
It is an interesting time though, because I feel like we're still, I mean, the May stats were not great, right? We're 20% below last May, which was also a slow May. But it seems pretty busy for mid-June. It doesn't seem like we're slowed down at all.
It does, but I also always like, I mean, with the exception of a few years where the market just seemed to power through, this is typically, we're getting to that part of the summer where it would be traditionally so slow.
Yeah.
Right?
But that's my point. It feels right now like it's like,
relatively busy.
Yeah.
Might just be your business. I don't know.
Might just be my business.
We'll see the stats because inventory is rising. That seems like
I'll take it.
Seems like a Matt problem.
But anyways, we're going to be talking about what's happening in commercial and how this impacts, if at all, the commercial market. So that's exciting. And we've got Jon Switzer coming on.
Jon Switzer of Impact Commercial. We're going to kind of break down what does this translate to? What does it impact? What does it not impact? What message does it send? And then what can we hope for the rest of 2024?
Sounds good.
Fantastic. Well, maybe we'll cut to our talk with past guest fan favorite, Jon Switzer.
Enjoy, guys. This podcast is presented by Impact Commercial.
Impact Commercial. John, Alan, the team over there are fantastic. They've all been on the show.
They have,
Friends of the show.
Great guys.
Wealth of experience. They can help with all your commercial financing needs.
Whether it's owner-occupiers, land development funds, commercial investments, or multifamily, these guys got you covered.
And they recently obtained their CMHC correspondent lender status.
So for all your commercial lending needs, visit them at impactcommercial.ca.
That's impactcommercial.ca.
Okay, so we're here with Jon Switzer. He is the managing partner at Impact Commercial. How you doing, Jon?
Doing great, guys. Thanks for having me on.
Yeah, thanks for taking the time. We should say past guest fan favorite as well. John's been on a few times.
Yeah, always great to have you, Jon. We appreciate it.
Jon, maybe for some of our listeners that don't know, what was the news from, was that last week now?
Yeah, it was last week.
Last week.
Yeah.
Oh, yeah, that little bit of news that you only see on the screen about 7 times a day. Yeah, there was finally a Bank of Canada announcement for a 25 basis point rate cut, which by the time they announced it, it was up in the air quite a bit. There was lots of very smart people saying no cut yet, but cut eventually, probably at the next meeting, and then you had the rest of the camp saying they were going to cut, and obviously they did, and here we are.
I've never seen so many people in my life. Maybe it's just me, but have you ever had just so many people like counting down the days to like the next Fed meeting? It's just like everyone's watching this thing like crazy.
Yeah, it's like a sports match. No, I don't think anybody's seen so much anticipation for a rate cut.
Well, I heard April's rate cut might be on pay-per-view.
Could be. But yeah, I mean, 25 basis point rate cut. I don't know how you guys feel about it. Like it's a sentiment thing at this stage, right? I think it's just got everybody feeling a little better about the future is really all that I think anybody will feel from that. You know, the bigger news is that bond yields continue to fall. So as we talk about every time, a mortgage broker is on, it's that fixed rates are derived from bond yields. Only variable rates are derived from the prime rate, which is directly linked to the Bank of Canada policy rate. So bond yields are down about 1% from their October highs. So that's what we are much more excited about than the rate cut, but they're related. So when they announced it, you could have said a lot of it will be priced into the bond market already, but there's always that little bit of extra because you've got the guys betting that they won't cut yet. So as soon as they announced it, the bond market reacted and sort of filled that gap. For the non-believers had to adjust their bets. So we did see bond yields continue to come down on that news.
So just for listeners at home that don't quite understand, Jon, if bond yields come down, what does that mean for fixed rates?
They pretty much come down lockstep, but it also depends on competitiveness in the lending space. So, we on the way up, when things were really volatile, we saw that lenders were increasing their spreads probably even faster than the Bank of Canada. So as bond yields were going up, lender spreads were also increasing. And at one point we had an environment where it was lenders were like 3.5% or 350 basis points above bond yields. And then when things get more competitive, which we're in a pretty competitive market right now, surprisingly, like not huge volume, but lenders do want to lend. So spreads are quite thin right now. You have more like a 2% spread over bond yields. And we're talking about Government of Canada bond yields. We should be very specific there. So right now we're about 2% spread. I'll call it on average.
So Jon, from like a layman perspective, me and Adam, we're going to go buy a commercial building, and let's say it's got all the earmarks of a good investment property that a lender is going to like. What would a 5-year fixed rate potentially look like on that deal today? Maybe what would it look like a year ago on the same deal? Just trying to give our listeners perspective of maybe where the rates were and where they currently are now if people are looking to buy.
Yeah, just I guess rounding up just to be a bit conservative, but you're going to be in the mid 5s. I'd say, I'll give you a range. I think right now on a 5-year, you might be, depending how quickly lenders are adjusting, you might be 520 to 550 on a 5-year. So things have really improved quite a bit. And then a year ago, I would add not just 1% for bond yields being 1% higher back a year ago. I would also add a bit of a risk premium because back then it was it wasn't like everybody was hungry to make a move both on the transaction and on the lender side. So you could probably add 1.25% or so to that. So, call it high sixes for a 5-year, mid to high sixes.
So we've seen a pretty good trend down then. If we were looking at the same property last year at maybe like a 6.5% interest rate, now we're probably looking around a 5.25% interest rate, give or take. So it seems like we're moving in the right direction.
Yeah, a really strong deal would be low fives right now. So we're absolutely moving in the right direction. Everybody's feeling generally just a lot better about things.
Does that move the needle in terms of properties that qualify or people that qualify?
Yeah, I think always, because when you reduce the interest rate, you improve the debt servicing with all else being equal, right? So it just means you need less money down essentially if all the other variables are the same. It's going to bring in a wider buyer pool when we get a better environment.
So that was going to lead me to my next question. With the interest rates dropping, all things being considered, how does that impact my loan to value from a lender? You kind of touched on it just very briefly there about down payments, but going from, say, a 6.5 cap rate on this great investment property to, say, a 6.5% interest rate to a 5.25% interest rate on the same property 12 months later, how would that impact my loan to value? Hypothetically, I'm paying $1 million. Like how much more can a lender or can a borrower keep in their pocket because of that 1.25% drop?
Yeah, I mean, it can make a big difference on the same property. If we assume rents have stayed roughly the same, like we're seeing a little bit of softness in rents, and Cory, you could probably talk with more expertise to that than me. But yeah, let's say lease rates are roughly the same. Property values have probably even softened a bit, potentially since last year, depending on where you're talking about. So it could be 10 to 20% down difference. Honestly, we were seeing things getting pretty dire at peak interest rates. We were seeing, I'll give you an example, like some of those light industrial properties, new builds that were coming online on Vancouver Island that I think we all are pretty familiar with at this stage. When we were modeling those a couple years ago, we were looking at very realistically 70% leverage or 30% down. When things were really hitting the fan, it was like 40 to 45% leverage and 55 to 60% down. So that's how much interest rates can swing, and that's because interest rates basically tripled from bottom to top. But this 1% or call it 1.5% move down in the last year, I would say it definitely improved things. Maybe 10% leverage or something along those lines.
Well, that's where I think that it's a lot of things on the investing side of things where people really get excited, and maybe they don't correlate necessarily the interest rate as much with the loan to value. But if I'm going to buy a property and I can say hypothetically get a 75% loan to value, which requires me to have a 25% down payment, I would gladly pay a slightly higher interest rate to have a better loan to value if my income is better versus buying that same property with a 50% loan to value. My leverage position's changing dramatically. And that's where I think a lot of the more savvy type investors, as much as the interest rates are important, that loan to value plays a huge factor of how much can I leverage that money versus what it was. And I'll only speak to Nanaimo because it's a market we know really well. If I had bought something for $10 million that I had to put down 2.5 3 years ago, but now I have to put down $5 or $6 million to buy that same property on that same income because of interest rates and the tightening of loan to values, that is what I think really, really impacts people's decision-making process because the leverage point is so important in real estate.
No, absolutely. And when you start layering that into, say, like into a development project, and the knock-on effects of, so let's say the Bank of Canada rate has an effect on land and construction financing. That part is better right off the bat on any Bank of Canada rate cuts. But then when bond yields and by association fixed mortgage rates are coming down, then the pro formas at takeout, if we're talking about a rental, the pro formas improve drastically when you lower the interest rate at all, right? It's just that cascading effect through the pro forma. And then on a condo project, you're looking at the ability of end buyers to do their financing. So it's equally important there. So it's really it really permeates through the whole picture when sentiment and affordability improve.
Jon, have you seen an uptick in applications?
Yes, for sure. Since the beginning of the year, we've seen a good cross section of increased activity in small and big investment stuff. Same for, I mean, owner users always been there, but it was pretty much pens down for a good portion of, late 22 through to mid to late 23. There wasn't a lot of activity. Owner users were just looking at combination of pretty close to record high pricing and record high interest rates and saying, this just doesn't make sense. Like it has to get better than this at some point. So yeah, I would say confidently we've seen a pickup in everything this year, and CMHC is going very strong in activity. I mean, the numbers look the best with CMHC, so that's kind of always going to be there. So yeah, I'd say across the board it's picked up.
And what type of product, I guess here, maybe let me start with this question. Are we going to see more rate cuts this year?
Yeah, I do think so. I'm not an economist. I'm just like the hungry hippo of data. I just take it as much as I can, but I'm not the guy, writing the models. But I think we could get, let's just say the market believes we'll probably get 2 more cuts. I think that's kind of where the predictions are in market right now. And I think it's similar for like the ECB cut around the same time, right around the same time. I think it was the same week. Same thing there. I think they're looking at 2 more cuts. The US, I think, is only looking at probably 1 cut this year at the end of the year. And if we go back to earlier in the year, I think it was March, the market was calling for 6 cuts.
Right.
I think both in Canada and the US. So things have absolutely, things have changed very, very quickly. And a lot of people will tell you they've waited too long. That's quite possible. I'm probably not smart enough to to really get into that. But I do think, from more of a layman's perspective, if you look back in history, if interest rates go up really, really fast, it's kind of like a mirror image on the way down usually. So I personally, based on just looking at history, wouldn't be surprised if rates come down faster than most people think. You just get into that new mindset. Everybody forgets about the past predictions, and it's a good chance the Bank of Canada finds themselves behind the 8 ball. There's a significant lag effect. So the last interest rate hikes probably still haven't even been felt by the economy, right? So got this rolling lag where they may just find, now we can't keep up with the negative impacts those past rate hikes are having on the economy, so they have to start chopping rates pretty quick.
So follow-up question to that then, Jon. So I'm looking for a commercial mortgage. What type of product are you recommending? Are you thinking is a 5-year fixed a good play right now? And I know it varies for each circumstance, but what type of advice are you giving people right now looking for a product?
Yeah, no, it's a very timely question, and the conversation has changed, amongst our brokers pretty steadily over the last couple of years. So I would say a year ago when we got up to those pretty lofty rates, we were thinking confidently we can be telling clients that they want to stay as short term as possible. And I will caveat that in commercial, that doesn't mean variable, because variable is just too expensive. In commercial, it's prime plus. So, when it was kind of risk off a year ago, we were looking at prime plus 1 to prime plus 2. Well, that would have been 8.2 to 9.2% at that time. So commercial, it just doesn't come into the equation the same way. So we were recommending a lot of 2-year back then. And that was simply because we had this really steep inverted yield curve, which is like an abnormal backwards yield curve where the short-term rates are very expensive, the most expensive, and then the 5-year and 10-year are the cheapest. And it's not supposed to be that way. So 1 year was just too expensive. 2 years was kind of the sweet spot. to take advantage of lower rates in the future. But now our conversation really kind of changed for the first time in our team meeting this week. We were saying, you know what, we stuck our necks out when rates were high and it worked out. It made sense, thankfully, in hindsight. But now we're saying if you can get a 5-year in the low to mid fives, some people are going to want to do that. Like, we're going to be more putting the option on the table and say, what makes you more comfortable? Is it a 2 or a 3-year in the high fives, and you're hoping that those short-term rates come down faster, which is quite possible, or do you just say, I don't want to think about this for 5 years, and the long-run average is probably mid fours for a commercial 5-year, maybe low fives is good enough just for that peace of mind, right?
Jon, one thing I wanted to ask, I know Adam talked about like the activity, and have you guys seen an activity increase on the lending side of things or the application side of things? Is there a particular market or maybe asset class where you've seen more of an uptick than expected?
Yeah, I would say the owner-user industrial, actually owner-user across the board has picked up more than frankly I thought it would, but I think a lot of that is prices came down a lot. Like prices in, call it medium bay, light industrial, have come down from kind of high 600s and to in some cases mid 500s. I've seen some product in Richmond built in the late 90s that would have been easily mid to high 600s a couple of years ago, go for around 530 a foot. So I think some of these price drops have outpaced the increase in the cost of capital. And so it brought the equation back in line where it works again for someone who really needs that space. And then, we don't see a lot of office strata. There just isn't much. But certainly retail, an uptick in retail for professionals, dental clinics, medical clinics. So those guys can get really high ratio financing. So as long as the need is there and the right space is available, the pricing is much more palatable now, and the interest rates matter less when we get this depressed pricing. It's kind of across the board. Strata is where we've really seen. I think that's kind of the first shot fired would be strata, because it's a more approachable market for like an average size business that there's a much larger number of, right? The big freestanding stuff is still moving slower, I would say, and then CMHC is just rocking like kind of like always, but it's even more attractive now, just relative to every other option.
Where like if a buyer's listening or an investor's listening, like where is the opportunity right now in your opinion?
Yeah, it's a good question. I mean that really depends on the buyer. I think if you can negotiate the right price on multifamily, which I didn't even really mention there, but that's certainly multifamily relates to CMHC, in lockstep. So multifamily is always such a strong proposition if you can find maybe a mismanaged building where there's a whole bunch of latent value that's just not been unlocked over the years. There's lots of different ways of unlocking value in multifamily compared to pretty much every other asset class, I would say, except for maybe logistics or something, more complex on the commercial side. So, and then combine that with just the financing and CMHC where it's about 1% cheaper on average, and you get longer amortization. So the numbers can work very, very well with multifamily. And then the rest of it just comes down to price. Like we're seeing, again, if you're a smaller investor, dip your toes in your first investment. I think industrial strata, maybe that's been sitting on the market for a while, and you can negotiate a really good price. I don't think you can go wrong.
And maybe as a final question, Jon, what do you think the commercial market does in the Lower Mainland or maybe the province in the next, call it 18 months here?
Oh, geez. I'm gonna have to put on all the hats for that one. I don't know if I'm qualified to answer, but I'll do my best. So personally, I'm buying my first commercial real estate, and it's a small again, light industrial strata. So I'm putting my money where my mouth is on that. I really do think that market's going to bounce back pretty hard over the next couple of years. Maybe it's even a year from now. Maybe we see substantially higher pricing, and if interest rates continue to come down, you're going to just see more and more people wanting to get back into the market. But we're going to have this supply-demand imbalance because one of the effects of the last couple of years is construction is pretty much dried up on that product, right? It was like everybody and their dog was trying to build it 2 years ago. And then, like in any market, it went through a massive shift, and all of a sudden the numbers didn't make sense, and they haven't for a long time. And honestly, I don't think they will for a long time or maybe for a couple of years from a construction perspective. So you're going to have this huge gap in construction in an environment where buyers are going to want to be coming back in. So I think that supply-demand picture looked really, really strong as a buy a couple of years ago. Then a year ago, it looked terrible. It didn't make any sense to get into the market. And now I think it's snapping right back to the other end of the spectrum where it's looking like it makes a lot of sense again.
John, I just want to throw something out there just because you guys may or may not see this on your side. One thing we talked about earlier this year was kind of the retail and kind of the rebound of retail this year. Are you guys seeing a much more interest in buyers maybe on the investment side where now they're looking to buy back into that retail asset class where maybe the last 2 years it wasn't as active?
Yes, for sure. So we talked about the smaller investor. For the larger investor, the open air shopping retail is everybody wants that. The lenders want it, buyers want it. Sometimes we call that a covered land play where, it's got great cash flow for as long as you want it to be there, but down the road, everybody knows there's going to be maybe one or two towers potentially on those types of sites, depending, of course, on tons of different factors. But that possibility is really there with those kind of older open air shopping centers. I'd say for a really well capitalized investor, that's probably one of the best propositions out there. And we financed a couple of those this year with some decent sized ones on the island. And we got 70% leverage on one of those conventionally. So that was unheard of in the last 2 years. And that's why you're getting a bunch of people flocking back into the markets. We're not miracle workers. We did all the right things, but that's more of a result of the environment getting better, not us doing anything super special. So you're going to just find people getting higher leverage on a given property than you would have a year ago on the same property.
So what you're saying is buy a single story retail building in a developing area that sits on a ton of land so we can develop this thing in the future as a covered land play.
Well, I don't think I have to tell you, Cory. I think it's probably a good idea.
Yeah, I think it's a great idea. Well, John, how can all of our listeners find out more about all the amazing stuff that you guys are doing over Impact there? And now that we're having rates come down, the activity is starting to go through the roof again.
Oh, for sure. We're super easy to find on Instagram. LinkedIn is where we're most active, and our website has contact information for all of our fantastic brokers. And we really look forward to hearing from anyone who thinks we might be able to help.
Thanks so much, John. Really insightful conversation.
Awesome, guys. Thank you. And we'll talk to you guys very soon.
Great. Thanks so much for your time, John. Take care. There you have it, folks. Our interview today with Jon Switzer, Impact Commercial, breaking down 25 basis points.
Yeah, really enjoyed having John on the show. Always a great time.
Always a great time.
All those guys are insightful over at Impact.
Well, when we had the rate cut, we had to go to our experts right away. So I reached out to them and said, guys, when can you fit us in? And to kind of John's point on the show, like they're busy.
Yeah.
There's a lot of deals happening.
Yeah,
so
exactly.
So we're very thankful for his time and gives us great insight for the rest of 2024.
What else do we got for the day? Or is that, Cory, how can people, if they want to reach out and talk not only about rates, but talk about the commercial market in general, how can they get in touch with
Yeah, reach out to us anytime at our Vancouver office, 604-428-5255. You can send me an email, Cory at williamwright.ca anytime, or go to our website, williamwright.ca, and sign up for the latest and greatest in commercial real estate.
Excellent. Well, have a great week, guys, and we'll see you next week with another great episode.
Thanks, guys. Take care.
Subscribe today.